Hi friends, my name is Rahul Jain. I'm a SEBI registered research analyst. When I'm creating this video, Strait of Hormuz is still closed. Israel, US, Iran have not yet signed a peace deal, and a lot of big statements are being released by likes of our Prime Minister Modi ji. For example, he recently said that gains of past decades will be lost if this crisis continues. If you look at Rupee is all-time low. It has hit literally 96.90 when I'm recording this video, and it's not just India's problem right now. Everybody across the globe is very worried. For example, UK's lawmaker, they are warning for a global food crisis. Okay, if I talk about some of the big investors, they are talking about, is the biggest US stock market crash coming very soon? Lot of pressure points for the global economy as a whole, and stock markets cannot be separated from economy. We all know that. Now, if the ongoing crisis does not stop very quickly, then of course stock markets are likely to be under huge pressure. There might be more correction in Indian stock market, US stock market and whatnot. And in such times, what will happen? The market at some point in time will make a bottom. I don't know when that bottom will be, but the market will make a bottom. But one thing is for sure, that when this happens, it also presents opportunities, lifetime opportunities for long-term investors. Because guess what? When the markets are at bottom, valuations become really cheap. Of course, you need courage. Of course, you need conviction. Of course, you need understanding of quality businesses so that you know what to choose, what not to choose, etc. But for example, back in 2008 when financial crisis happened, at that time people like Warren Buffett, they heavily invested in stock market. I mean, there is a big article about which are these top 5 investors. I'm not going to go into details of that, but we all know if we understand the quality businesses, then there is definitely a case of investing when the markets are really crashed. Not right now, but maybe when markets are really crashed down. That's why in difficult times like these, what really becomes very important for investors is to understand and continue to learn about quality businesses. In that spirit, I started speaking about quality companies on my channel, and very recently I created this video where I spoke about 3 companies, their business mode, their past track record from an earnings perspective, and a lot of other insights about these particular companies. And on that video, a lot of you requested that, Rahul, can you make a series of 30 to 40 companies so that we can understand what's going on in these quality companies. So what I've decided to do is I'm going to give you a series of 40 stocks in the next few weeks. If you're new to my channel, I request you to hit the subscribe button. Why? Because YouTube is not releasing all videos to everybody. Mainly it is releasing the videos to subscribers only. So hit the subscribe button and press the notification bell so that whenever I am uploading these videos, you immediately get notified and you can easily understand these quality companies. One last request, that please do not write down the name of these companies in the comment section, because a lot of people will just read the names and might blindly invest and might lose their money. These videos are not buy sell recommendations. If somebody is really serious about learning about these companies, they will have to watch the video. With that spirit, in this video I'm going to cover 3 companies. This is part 2. In part 1 I already covered 3 companies, so company number 4, 5, 6 I'm going to cover in this video. Let's get going. So the first company I'm going to speak about in this video is State Bank of India. A lot of people will say SBI is a Sarkari company, very badly managed company, etc. But allow me 3-4 minutes of time and you're going to learn about this company's turnaround. Okay. So very recently SBI crossed 10.4 lakh crore of valuation and became 6th largest company by market cap. Okay. Of course, this market cap has been eroded due to the market correction right now that is going on. But I want you to focus on this chart here. And what you note is that between 2010 and 2020, the State Bank of India eroded money for the investors, as you can see on my screen. Okay. Nothing. The stock did not move at all. And all of a sudden, since 2019-20 onwards, the stock picked up big time. Okay. Now, what happened here? This is very important data point that you need to understand, because this history will tell you what has happened in the past with SBI. So I went through their annual report. Okay. Now you see the data from 2010 to 2020. One data point that you need to read from is net NPA. Net NPA is the bad loans. Okay. Now see how these net NPAs were rising between 2010 and 2020. 1.63%, 1.82, 2.1, 2.57, 2.12, 3.81, 3.71, 5.73 up until FY 2018. Okay. Only after FY 2019, these NPAs started to come down. Okay. It was at the peak at around 5.73%. So when a bank's NPAs are continuously going up, investors will not touch it. Okay, they understand that bank is giving bad loans. Now a lot of people will say politics was involved, this was involved. I'm not concerned about that at all. For me as an investor, what I'm seeing is that the company was giving bad loans at that time, right? Now after FY29, if I show you the net NPA number here, you see it started to come down. 2.23, 1.50, 1.02, 0.67, 0.57, 0.47 in FY25. These are very, very good numbers. So what happened here? And as a result of this, you can see that between 2010 to almost 2019-20, nothing happened in the bank. But after that, it picked up. Okay, so you understand what happened here as a background. Now you have a natural question that, Rahul, how did this bank turn around? Very, very simple. They did not do anything magical. They actually wrote off a lot of bad loans. Here is the data for you. FY27 onwards, you see how many loans were they writing off? Writing off meaning they were not even recovering them. They have just written it off from their balance sheet. 27,000 crore, 40,000 crore, 58,000 crore, 52,000 crores, right? So a lot of PSU banks at the time were cleaning up their balance sheet, right? Now, if I fast forward to between 2020 and 2025, you see these write-offs have started to come down from 52,000 crore, 34,000 crore, 19,000 crore. You see the scale has come down slowly. So as of FY26, less write-offs are happening. The bad loans are less. As an investor, if you see, the bank has turned it around from where it was before FY20. Now, also, if you look at the loan growth rate of SBI, here is the data for you from FY14 to FY26. And the reason I'm presenting you all of these long-term trends is that I'm not looking here quarter by quarter what is happening. Those are operational details. Here we are talking about people who want to invest for long term. They need to understand the story about that particular company. Okay. Here you see the blue line here. What is the credit growth rate? What is the rate at which the loans are growing up? And as you will see, FY14 onwards, they were in decline from 15.4 to 7.3, 4.9, 5.6, 4.8. But since FY20 onwards, the credit growth also has picked up 11%, 16%, 15%, 12%, and FY26 was around 16.9, highest credit growth rate that SBI has seen. But can they sustain it? I doubt it, because the management themselves is saying that they're giving a credit growth guidance of 13 to 15% for FY27. Now beyond that, what will happen, we don't know. Even what will happen in FY27, we don't know right now because of the war going on, because of the oil prices very high, because of the inflation, etc. That's why there is a lot of fear. So this guidance may not be fulfilled. We don't know yet because there is a lot of uncertainty in the market. But as a result of this turnaround, if you see the return on equity, that has improved a lot. It's gone to almost 20%, 19%, 18%. If you look at return on asset, very, very important metric for banking stocks, that has also gone up consistently every year, and it is now at 1.12. Fundamentally, if I show you some more data points about the bank's deposit growth rate, loan growth rate, and the PAT growth rate, last 11 years data I have studied, and in front of you, you see the deposit growth is around 11.92% CAGR basis, loan growth 11.68% CAGR basis, PAT has grown at around 20.87% CAGR basis, albeit the variability in the PAT, you see in the last 5 years, the PAT growth rate has been exceptional, right? But a company that has delivered such huge growth rate in the PAT, the loan growth rate, deposit growth rate in the last now 10 to 15 years, with lowest NPA now, in my view, can be qualified as a good quality company. Now, I do not know what the future will entail, but what I know is that differentiator that SBI brings on table. Have a look at this. What you see is the savings account balance in SBI. And if you go back to 2014 onwards, one of the business moat you can call about SBI is that the savings bank account that people keep opening in SBI is at a huge scale. And if the savings bank accounts are higher in proportion, because banks only pay 2 to 3% interest on that, that money is there to loan out at 8%, 9%, 10%. That is where the margins are very, very high for banks. We all know that, right? That's why we look at CASA, current accounts, savings account, etc. March 2026, 18.8 trillion rupees are sitting in the savings bank for SBI. This is a number that you need to compare with any other banks. Now, I'm not saying that SBI is the only bank. There are other very, very good banks as well. I'll talk about that in going series as well. But here, if you look at this, this is unmatched liability franchise when it comes to SBI. In fact, in FY26, every single day, 63,000 savings account opened in SBI. That's a huge number, and you should compare this with other banks so that you get a compare and contrast as well, right? As I speak about other banks, I'm going to start looking at this number as well and might give you some commentary, right? So this is SBI. Now coming to the final point on SBI, which is the valuation, because I'm not going to give you operational details of what is the names, what is the CASA right now. Okay, I've given you the long-term trend, I've given you the turnaround story of SBI, right? There might be some pressure in the next 1 to 2 years or whatever because of the bad economic conditions. But if you look at the valuations, last 5 years makes very good sense. If you look at the valuations, price to book ratio of this company or bank has been 1.5 median basis. Okay, it is right now at around 1.5. If you look at the lowest, it has gone to 1.3. Okay, and at 1.3 it has sort of made the bottom. Okay, this is the least valuation that it has seen in the last 5 years. If I talk about last 10 years also, the least was very low. It was around 0.6 back in COVID times, but that was an exceptional year. If you remove that, lowest you will see here is around 0.9. But I think the company or the bank has re-rated itself now because of the NPAs that I talked about, because at the time NPAs were very, very high. That is not the condition right now. So if I just consider 5 years mean price to book ratio, then the minimum it has gone to 1.3. That's all I can say right now. Okay, it is trading at around 1.5, but this is a quality bank, likely to continue. It's not going to go insolvent or whatever in the next few years. It's a long-term company that you can go and explore. I'm not saying that go and buy this. Absolutely not. It really depends on your portfolio, your risk appetite, and many other factors. But hopefully this 5 to 7 minutes of commentary have given you something new about SBI that you did not know. And if you like that, request you to hit the like button. Let me know in the comments a simple thank you. It motivates me to do some research for you that brings you a lot of insight. Also, let me know in the comments any other companies that you would like me to involve in these 40 stock series. Of course, I have a strict criteria that I will only speak about few stocks that I feel are quality companies. I'm not going to just take your suggestions on the face of it, but still drop them in the comments and let me know why you think a particular company is a good company, while I move to company number 2 now. Now, before I say the name of the second companies, have a look at my screen. What you see, a trend of rupee depreciation here. Between 2000 and 2020-26, last 26 years, rupee on an absolute basis has depreciated by around 113%. And almost on a yearly basis, if you look at the CAGR, 3% depreciation in the currency. Okay. Now, if you look at the calendar wise, you will see that there are years where rupee has appreciated. For example, 2003, 2004, 2005. But all in all, if you see, overall, the rupee depreciation has happened over the last 26 years. And in 2026, the situation has gone really, really bad. Almost 12% depreciation we have seen in just 2026. Okay. Now, this brings me to a point that we cannot just rely on Indian stock market, mainly from a currency hedge perspective. We have to look at global markets. One of the global markets definitely is US. Stock market right now in US, there are people saying that valuations are very high. There might be a correction. We don't know. If the correction happens, yes, that will be a great opportunity, right? We don't know that. Therefore, I'm going to include around 10 companies from US as well into this overall 40 companies basket, so that around 30 stocks from Indian market, 10 stocks from US stock market gives us a very good rounded view about both India and US stock market. So with that spirit, what I'm going to do is speak about the first US company in this video, which is Google. Now, I've logged into Vested, a US investing platform that I'm personally using. If you want to use it, I've given you the link in the description and in the pinned comment. But when I type here Google, what you note here that you get two companies. GOOG is the ticker for the first one, which is the class C share, and GOOGL is the second company that is giving you class A shares. Now, what is the difference first of all between these two companies? So class A share means that this particular stock, if you buy, then you have one voting right. Class C does not give you any voting right. There is also a class B share, which is not yet listed, which is held by promoters, and I think that has around like 10 voting rights. So the main difference between these stocks is the voting right. Now, as such, the dividend will not vary between stocks. As such, the economic ownership of these stocks will not vary, right? So which one is a better one? So if I talk about the price here, for example, if I look at class A share, right now the price is at 387. If I look at class C, it is 384. Class C is slightly cheaper because it does not have the voting right. But for me, does it really matter? Are you going to vote whenever there are any voting right exercises to be done? I don't think we are going to vote. But again, it's your choice. I've given you the difference between A and C class shares, right? Now, coming back to Google, what you will note about this particular company, if I go to the fundamental tabs here and come down to the cash flows, what you will note here is that the company's free cash flow has been very, very strong in the last 5 to 7 years if you see. So here, for example, this is year FY21, okay, ending December, 67, 60, 69 billion dollars, 72 billion dollars, 73 billion dollars, right? Now, what does this free cash flow allow Google to do? Okay, this is what you need to understand. So if I talk about the capex of Google, so again, you go to here, for example, earnings. So you can click on earnings call transcript here on Vested. You can read their latest earnings presentation, but I'll give you some sample of it. What it simply does, the cash flow it does is that it allows the company to do a lot of capex, okay? So for example, FY26, their capex, they have now revised the guidance. It's going to go up to $180 billion to around $190 billion. Previously, it was around $175 billion to $185 billion, right? And in fact, in FY27, companies saying is that they are going to do significantly more capex, okay? And therefore, short term, there might be a pressure in their profit and loss statement. So if you see Google's profit dipping, you have to first ask whether the capex has gone up or not. Because if the company is putting a lot of capex, then of course there might be a pressure on the P&L, okay? But all in all, the strong cash flow allows the company to reinvest that cash back in the form of capex. And more importantly, what you need to understand is where are they doing this capex. So for example, here in the last con call, they talked about 60% of their investment is going into technical infra and 40% is in data center, etc. So they are putting money in the capex for the futuristic technologies, for example, data centers, right? Now, why is the company doing it? Simply because management says that they feel the growth is coming from these segments. And in fact, they're talking about ROIC, which is the return on invested capital. That is looking very, very solid for them, and therefore they're putting this money. Now, whether this capex will really give them that benefit or not, I don't know. Nobody really knows the future. But as of now, strong cash flow getting converted into capex is what we need to know about. Now, fundamentally, if you look at Google's return on assets or return on equity, very, very high. Return on equity, in fact, is around 38% last 12 months. And all of this data you can see invested, right? And this get updated very frequently. But the point here is that fundamentally, it is looking very, very good as of now as well, right? Again, I'll come to valuations in a minute, but if you look at Google's last 10 years fundamentals, be it revenue growth rate, EBITDA, net income, EPS, if you see EPS has grown at around 26.74% in the last 10 years on a CAGR basis, okay? If I now talk about the valuations of this company, it is overvalued from its long-term valuations perspective. You can see so many parameters I've given you here, be it the price to earnings in terms of the trailing 12-month forward basis, etc. It will definitely look overvalued from a long-term perspective. And that is where I see that if you see stock market in US corrects heavily, and if you see Google is correcting, right? I don't know, again, depending on how much correction will happen or whether it will happen or not, we don't know that, right? But again, I'm talking about hypothesis here that if markets correct, then companies like these make a lot of sense, provided you have all of this background, that what is the growth rate in Google so far, why the company is slightly different from other companies because of the strong cash flow, etc. Right? Those things you need to know. If you really want to understand more details about Google's business model, where the revenues are coming from, I've done this video for you. It's still on the channel. Done it in the last 4 months. Go and watch that video. You're going to learn about Google's business model, right? So that you get really, really well prepared about Google's business model. Finally, if you want to start your US investment journey, then start with Vested. I've given you the link in the description and in the pinned comments. The reason I personally use Vested is that it is offering more than 10,000 plus US stocks and ETFs. You will find managed portfolios as well if you're not comfortable picking individual stocks. So there are a lot of good options there. If you use my link, then you are going to get $10 deposited by Vested into your funds the moment you open the Demat account and you do your first transfer. After that, you're going to get $10 free from Vested as a first deposit into your account. The link is in the description and in the pinned comments. With that, let's move to company number 3 now. The third company that I want to discuss is Reliance Industries Limited. Yes, you heard it right, Reliance Industries Limited. Why? There is a fascinating thing you need to know about Reliance Industries. Okay, so have a look at this chart first. What do you see? That between 2008 and 2000, almost let's say 10 years, stock did not do much. In fact, it eroded the value for investors. 339 said 234. Okay. After that, what happened? January 2018 onwards, that was the tipping point, and see what happened to the stock. Okay. Now, what happened here? You need to understand 3 phases of Reliance. Okay. So here is the period FY 2010 to 2013, then 13 to 20, and then 21 to 26. The notable difference you will find between these 3 phases is that the estimated total capex that the company did. How much capex did Reliance did between 13 and 20? It was huge, 4.5 to 5 lakh crores. And more importantly, they added new businesses, for example, Jio Telecom, right? And that is where the growth started coming in. If I show you some data here, for example, fundamentally, if you look at it, up until 2017, if you look at the top line, if you look at the bottom line, very, very stagnant. Okay, there was nothing in terms of the growth. See what happened after FY 2018 onwards. You see the growth started to come in. Okay, you see the profits started to go up heavily, right? And more importantly, if you see this chart here, what you would note is that back in FY21, 39% of the EBITDA, which is the profitability of Reliance, was coming from their O2C, which is the oil to chemical business. As you can see here, excuse my writing has gone horribly wrong here. But as of FY26, that same contribution has dropped to almost 29% in EBITDA. What is it telling you? If I talk about their consumer businesses now, which is their Jio Telecom, etc., right? Retail, Jio Telecom, Jio Finance, all of that, if you put together, now the company's 55% of EBITDA is coming from consumer business. This is a conscious choice that Reliance have made, that they are now becoming more and more consumer oriented businesses that you will see, right? Again, I'll talk about few other initiatives that the company is doing, but you will note that every 10 years or 15 years, Reliance is a company that pivots its businesses. Okay, Mukesh Ambani's leadership has been phenomenal. Again, I'm not going into the politics of it, and a lot of people will blame them for whatever reasons. All I'm seeing here is from a business perspective, the company pivots almost every 10 to 15 years. They add new businesses that are giving them growth for the longer term. So it's not about short term, long term growth perspective. The company has pivoted into more consumer oriented businesses. For example, again, coming back to this chart here, 36% of their EBITDA came from digital services, which is primarily their telecom business. Okay, that is huge contribution in profits. Now oil to chemical or oil and gas is no longer the number one business that Reliance holds, right? It's the consumer oriented businesses, right? You need to understand this critical point about Reliance as a business, right? Now coming to the stakeholders, what you would note is that a very similar pattern followed from 2019 onwards, where promoter stakes went up. You see FI started to buy more of Reliance. DI started to also buy, but recently what you will note, last 3 years, FI started to trim down their position. Overall, FIs have been sort of leaving Indian stock market in the last 3 years, and that's the phenomena you will see, because companies like Reliance, HDFC Bank, these are the primary holding for the foreign investors. DIs continuously starting to buy this particular stock in the last 3 years or so. I'm again talking about 3-year, 5-year trends, not 1 quarter, 2-year trend here, because I'm talking about long term here, right? If I talk about the balance sheet and the cash flows, as you will note here that the capex, if you see, this is the light gray bar here, light blue bar here. Capex has been going up almost every single year here, and the cash profit that you see here is all-time high. Okay, so company is generating a lot of cash profit, and that is going into capex as well. Of course, the net debt has also gone up, but that's okay. Businesses like these will continue to borrow more money. Why? Because they're investing in their growth, right? Now coming to the valuations of Reliance. Okay, now if you see the price to earning ratio of last 5 years, median has been around 25.6. Right now it is trading at around 22.2. The lowest that we saw is in FY23 here, okay, around 21.6. Okay, these are the valuation points that you need to understand. But the important point is that, can Reliance sustain this growth? Can Reliance pivot to many more businesses? So here is what you need to know for that. Okay, if you look at 2026 to 2035, the businesses that they are investing in terms of capex is AI data centers, green energy, 5G, 6G infra, battery gigafactories, hydrogen, ammonia, retail expansion, geo finance, media content. There is a lot that this group is doing, and it is not going to be just a refinery sort of a company. It is going to pivot to even newer technologies like AI data centers. So for example here, when it comes to AI investments, they have announced around $110 billion of investment in the next, 10 years or so, whatever, right? Okay. If you look at the green energy, they are talking about hydrogen moves, mega solar investments. Again, you can go and read about those things. 6G technology, Jio is going to heavily invest. So they are very futuristic business. Again, I'm not trying to sell the company to you, but I'm giving you that picture that longer term, these businesses will pivot. The market cap should swell, in my view, if you look at the 10-year horizon. Again, don't look at it from a 1-year, 2-year perspective. Valuations wise, the PE right now is, fairly, but if the market correction happens, if the market really becomes very, very discounted, these are the insights that will help you understand about these companies. That's the intent here. Okay. This is the third company that I've spoken about in this particular video. I will create a lot of other videos, around 10 to 12 videos covering 40 companies, giving you their critical business modes, their business pivots, etc. This is a broader view you need to know about a particular company. If you're liking this, request you to leave me comments like, should I continue with this series or not? Is it adding value or not? If you want me to improve it in any aspects, let me know as well. But please don't ask me to give you buy sell recommendations, no trading tips, etc. This is all about business analysis. This is all about looking at these companies from a different lens. Hope you're liking this. Also, you can consider joining my YouTube community. Almost on a daily basis, I'm posting, navigating people through the difficult times that we are seeing through. That will also give you a lot of practical, emotional aspects of investing. These are not stock buy sell recommendations. Again, a lot of good practices that I personally follow. I share that with practical examples on my community. The feedback has been good. Simply go to my channel, subscribe to the channel, and then find the join button for the community. With that, I'm going to see you in my third video for this series very, very soon. Hit the subscribe button now. I'll see you later. Until then, keep rocking.